This is Tax Chats. Hello, I'm Scott Dyring.
And I am Jeff Hoops.
And we're here to chat
about taxes.
Hello, and welcome again to Tax Chats. I'm Scott Dyring, and I am joined by my colleague, Jeff Hoops at UNC. Jeff?
Hello.
As you know, Jeff is a tax researcher extraordinaire and the curator of the UNC Tax Museum, which, if you're watching on YouTube, you can see on the shelves in his office behind him. And by the way, Jeff, we keep talking about the Tax Museum. One day, we're going to need a tour of the Tax Museum, of an audio tour of the Tax Museum.
I'm going to have to book far in advance because the tickets sell out quickly.
They sell out quickly because there's not a lot of square footage in the Tax Museum.
Correct.
Okay, so today we're going to talk about the Billionaires Tax, a tax that we have discussed briefly before, but I think we'll have an interesting angle on it today for you. But just a little bit of background. So over the past several years, issues like wealth and income inequality have, I would say, risen to the forefront of the national conversation. And going back to the presidential election cycle, the campaigns, there were several proposals to deal with wealth and income inequality through the tax system, to figure out ways to impose higher taxes on extremely wealthy
or any
people.
taxes, not just higher taxes, maybe, but even any taxes.
That's correct. So not just more, but some taxes. And those proposals have had various incarnations. Going way back to the presidential campaign, there was basically a wealth tax proposal, which would be something like calculate how much wealth you have, impose some percentage of tax on that wealth. That has come and gone. Then there have been various other proposals which are related, but not exactly the same thing. And the latest incarnation, which has appeared and gone away and appeared and gone away in various proposals related to the current tax reform, is what is being called the Billionaires Tax. And it's not really a wealth tax. It's more of a special kind of income tax on really, really wealthy people. And it's controversial. And one of the reasons it's coming and going in the various proposals is because the politicians are having a bit of a hard time getting enough people on board with this type of tax. And so Jeff and I have been thinking about this and the latest incarnation and talking about it. And we recently saw a letter written by a few, but signed by over 200 economists and lawyers supporting or in favor of the Billionaires Tax. So Jeff and I said, what should we do? And Jeff, what was your solution?
We should find one of the people who helped write the letter and talk to him about it.
So that's what we have done today. So Jeff, tell us who you found.
So we have Brian Galle, who is a professor of law at Georgetown University, here with us to talk to us about the Billionaire Income Tax. To be clear there, it's not the Billionaire Tax, the Billionaire Income Tax. I think very specifically we want to include that word income in there.
Hi, guys. That's definitely important to lawyers.
Yeah.
Thanks for coming on, Brian. It's really great to have you.
So
Sure.
Brian's research focuses on taxation, nonprofit organizations, behavioral law and economics, federalism, and public finance economics. He received his JD from Columbia University and an LLM from Georgetown. We're excited to have Brian on. So just as to get us going, Brian, so we have this Billionaire Income Tax that you folks talk about in this letter. Can you tell us first just what the general problem this tax is trying to solve, and then just tell us a little bit about the tax, and we'll dive into the details after that?
Sure. Scott talked a little bit about the problem already, right? It's that in our income tax system today, if you're very wealthy, your income taxes are basically optional. And that's because of this principle I'm sure your readers know about, your listeners know about, called the realization rule. What that rule says is if you own stock or other valuable property, you only pay tax on your profits in that investment when you sell the property or otherwise dispose of it. So, for example, let's say you founded Facebook. Your shares have gone up by, $30 billion. you don't owe any tax on that $30 billion until you decide to sell.
So when you used the word, you said optional. It's not that it's optional. You just don't owe any taxes. It's not like, well, it's a, I mean, in the letter it says suggestion. It's not a suggestion. You just don't owe any.
Well, you choose when your taxes happen. And one of the options, through a combination of unusual U.S. rules, is never. And so if one of your tax options is never,
I would choose that one if given the option.
Yeah.
Well, talk to us just a little bit about why one of the options is never.
Right. So just to go to the Zuckerberg example, right? So you don't pay tax until you sell the stock. But what happens if you die and you still haven't sold it? Your heirs receive that stock and they don't owe any tax on any of the appreciation in value. They don't owe any income tax on any of the appreciation in value that happened while the stock was in your hands. So that $30 billion will never get taxed by the income tax.
And when you
system.
say any income tax, what tax might they owe?
Well, there could be a tax on the estate before the money gets to their hands.
There's good ways of getting around that, I assume.
There are a lot of good ways of getting around the estate.
Good or bad, depending on who you are.
There are a lot of very effective ways of getting
effective. See, that's spoken like a true lawyer. The accountants don't know the right words, and the effective seems like a much better way to describe that.
Right. So, like, as a result of these rules, Jeff Bezos, for instance, according to ProPublica, was reporting less than $200,000 a year in income tax, even while his wealth was kind of shooting off into space, right? And so that's what the billionaire income tax is supposed to solve. Essentially, it says every year you're going to pay tax on the increase in value in your assets, whether you sold them or not. So if your Bezos and your stock went up by $10 billion in 2020, you're going to have $10 billion in income.
So actually, you're winding a little tiny bit. This problem with our income tax, as you said, you don't have to pay tax unless you sell. Is that a uniquely American problem? Do other countries do it the same or differently, or?
No, this is very common. I think almost every income tax that you could think of has that realization rule as its central feature.
So is there realization? Some problems with the income tax or things we say as problems, they're like just historical accidents. Some of them are just like it's a convenient way to do it because the way the world used to be. Why do we have this realization principle?
It's mostly about valuation. The idea is that it would be hard to tote up the value of everything in the tax museum and the Hoops family,
it's actually pretty easy.
the Hoops family Yaris and whatever other assets there might be every year. You'd be spending a lot in administrative costs, and there could also be other unwanted economic effects too. People might intentionally buy things that were especially hard to value on the assumption that it would allow them to pay less tax, and that would kind of distort the economy.
Is another concern like liquidity? So if I look at the amazing tax museum behind Jeff, and suppose that there was something that was actually valuable in there, which is debatable, but let's suppose there was something that actually had real value. And if it went way up in value next year, and so Jeff owed tax because it had increased, how would he pay the tax?
Right. I mean, historically, liquidity has been another one of the concerns. It's certainly a concern for the property tax, which is sort of a mini wealth tax that most American homeowners pay. And so the city of Chicago, for instance, discovered this was a big problem because there were elderly folks whose, homes had gone up a lot in value and they didn't want to sell their home to pay their property tax. And so Chicago came up with this idea that, basically Chicago will lend you the money to pay your property tax until you die or sell the house, and then they collect it. So traditionally, yes, liquidity was another big reason to have the realization rule. It's just worth, and we'll talk about this maybe a little bit more, it's worth realizing that for most billionaires, neither of those is a real concern, right? Like most of their wealth is in publicly traded stock that's valued to the microsecond, I don't even know what the Greek word is, but to the 1/1,000,000th of a second. And it's also incredibly easy for them to access that money without selling the stock.
So both of these concerns were especially problematic with the wealth tax, where you just wanted to value everything. But this billionaire income tax, you don't want to tax all the increases in their assets. It's only some, right? And I think that's super important as far as valuation goes. Because I mean, even if 95% of your income or your wealth is in publicly traded shares, even if that 5% could cause a lot of administrative nightmares, you kind of get rid of that 5% with your proposal.
Right. So what the tax does is it has essentially two different systems depending on what kind of asset is being taxed. If you have a publicly traded asset, or at least one that's traded in a market where we have, regular, reliable, timely valuations. There are some websites, for instance, where you can trade stock that isn't public yet. If you're the employee of a company that's going to go public in a couple of years, those are probably covered under the bill too as publicly traded.
I missed that. It's not just publicly traded shares. You could have privately traded shares, and if they're traded on some market, they're taxed.
Right. A market with basically, as long as there's regular, reliable valuation, they're going to be taxed under the so-called mark-to-market system. They're going to be taxed annually. Well, what do you do with the gold that's buried in your backyard or with the tax museum? There's an alternative for that. The alternative for that is we just stick to the usual realization rule. We're just going to wait until you sell it so we know how much it's worth, and you might have cash in hand to pay the tax. But the addition that's unique about the bill is there's an interest charge that comes with that.
So, sorry, you said you used gold as an example. Would gold be not taxable on an annual basis? You can discern the value of gold quite easily, actually.
Yeah, I think commodities probably would be taxed annually. I guess I was thinking if you had some unique gold artifact.
Okay, so it'd be like art.
Looted or something.
Art would not be taxed annually.
A Spanish gold coin, which is
your
worth
home,
more than the gold itself.
Real estate.
Right.
Bill Gates is like the largest farmland owner in the United States. All of his farmland would not be taxed annually.
That's right.
As a farmer, I approve.
Right.
A former farmer, I should say. Jeff is constantly talking about my turkey wealth, which I inherited from the turkey farm, which no longer exists. So I'm not getting too wealthy.
They realized.
It was all realized, yeah, and spent. Okay, so that's kind of a fascinating way to think about this. If it's something that can be valued, then and is somewhat liquid, I guess, really, because it's being traded, then you're arguing it could be because the value is discernible and it can be sold or purchased fairly easily. That makes it easier to tax the unrealized gains, and so why not tax them?
And there's an analog in financial accounting, right? In financial accounting, you're allowed to mark-to-market assets, and they have these different pools, and the pool that you can value, in some cases, they market-to-market.
Yep.
Right. Now, the difference between financial accounting and tax is, although there might be some motivation to hold assets from an accounting perspective, if you want to make your financial condition relatively opaque, that might be a reason to put assets in categories that are not marked to market. It's certainly not nearly as strong of an incentive as when they are being taxed. And so the big concern about having these two alternative tax regimes sitting next to each other is you would worry that people would rather have the regime where they don't pay tax every year than the regime where they do pay tax every year.
So how would you do that? If I'm a billionaire, how do I get how do I shift income to be classified as non-taxable? Shift assets.
Yeah, well, one way to do it might be to sell them.
But then they would be taxed.
But then it'd be realized.
Right. So the other is this is obviously an argument kind of for why the statute is has less of an economic impact than some people might want. Like, there aren't a lot of ways, if you already are holding public assets, there are not a lot of ways to turn them private. But from a tax planner's perspective, there is still a potential tax advantage there to going private, let's say. You could sell the public company and refinance it and turn it into a privately held company. That's what a tax lawyer would call a freeze transaction, right? You're going to pay tax now, but then any subsequent depreciation is not going to be subject to that annual tax.
So sorry, if a corporation went private, it's now public, but it went private, it delisted, that would somehow trigger a tax? Well,
right, because at least the shares that are sold.
You don't necessarily have to sell any shares to go private, right? You just stop listing them on the stock exchange, stop filing annual reports with the SEC.
Yeah, that is very hard to do with a public company without refinancing.
So, here's another question, like just a potential ramification. If, there's all these tech startups, right? And we hear about them and there's, they become unicorns because they get a giant round of equity infusion, but before they're public. And then many of those companies have the goal to go public because the founders become uber wealthy, right? And one question is whether this tax might create an incentive for companies to stay private, to become like a Koch Industries as opposed to, General Electric or something like that.
Yeah, exactly. So that's another one of the concerns that motivates another important feature of the bill, right? So there might be a number of margins in which you could potentially avoid this annual taxation by holding private assets. Even if you hold a lot of publicly traded assets now, new assets that you acquire, you might on the margin kind of prefer to acquire private ones, you might think, if that would be a way of escaping the billionaire income tax. And so let me just finish this key feature, Jeff, just to get that on the table, and then let's talk about the other stuff. So that's the other key feature is the interest charge. So yes, you can get out of annual taxation and get back to the realization rule that everybody else has, but now you have something else that nobody else has, and that's the interest charge. So the longer you hold the asset, the more tax you'll pay. So you'll pay an extra tax on top of your profits to reflect the fact that essentially the government gave you a loan of the amount of the tax, like the city of Chicago plan that I talked about before. The government essentially lends you the money to pay the tax and then reclaims that money when you sell plus interest. And the idea behind the interest charge is it's set at about the level that on average we would expect someone to make in profits from the average investment in the economy. So from an ex-ante perspective, you shouldn't expect to win by switching into private assets and holding them for a long time.
So is the interest rate going to be something, like the S&P 500 returns, 8% a year or something like that? Or how would that be done?
No, because it's after accounting for risk, the average return in the economy is a lot lower than that. So the statutory rate right now is AFR plus 1%. So it's the rate the federal government borrows at. So if you were going to buy bonds, plus about 1%.
I see. Okay. Jeff, you were going to say something earlier. Do you remember what it was?
Just to ask more questions about going private.
Yeah.
I mean, firms do this, right? So in accountants' memory, back when Sarbanes-Oxley happened, there was a number of firms, hundreds of firms that went private by doing what they call go dark. So is that not a concern that if you calculated, for example, where some billionaires would be now, if we had this tax, let's say in 1990, they'd be way, 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 way poorer today had we had this tax for 30 years. So looking forward, it seems if you're starting a company, you just don't go public or you go dark like they did as a result of SOX in response to this tax. Is that a concern or not really?
Right. So again, I agree that one possible response to the existence of the tax is to stay private for longer than you might have otherwise, and that might be indefinitely. Although at most firms that are going to scale up even today at some point have to access public markets. The argument again is that although yes, you get out of mark-to-market annual tax on their increases, you also stumble into the interest charge.
So the interest based on this value that's very difficult to value though. Right, so somebody's going to have to assess the value, you're charging the interest based on this.
Well, no, so the way that it's going to work is, let's say that you have your initial cost of acquiring, you're the founder, your initial cost of acquiring the shares is $0. You sell them when you're 80 for $10 billion. The way the statute works is it's going to look at how long did you hold the shares, and for each of the years that you held the shares, it's going to charge you interest, assuming that $10 billion in increase happened essentially equally over each of the years. So let's say you held it for 10 years. We're going to assume there was $1 billion increase each of the 10 years. So for the increase that happened in the first year you held it, that's 10 years worth of interest at, let's say, 2.5%. The $1 billion in profits that happened in the second year you held it, you're going to owe 9 years of interest at 2.5%.
But that all happens at year 80. So if I'm 40 right now, I hold for 40 more years, I pay this tax in 40 years.
Yes.
So when I teach taxation of investments, where it's all about like trying to make predictions And we have these very nice formulas that say, should you do a Roth IRA, a traditional IRA, all these different kinds of things. I mean, to me, one of the big summaries is like, if you're trying to predict what our tax system looks like in 40 years, like, good luck. There's no, I don't know what's going to look like tomorrow. So why should I have any confidence that a Congress in 40 years is going to be willing to collect this tax?
Well, so you're asking, I think, two different questions. One is kind of the finance question, and there I would just say, don't ask me, ask Alan Auerbach, who invented this idea, the retrospective interest charge, and he kind of shows mathematically that in expectation, you can't come out ahead.
Well, in your expectation, if you actually expect Congress to collect it.
That second point, I think, is the key. I have a co-author who calls this the political optionality point. And the idea behind political optionality is, if you have an opportunity to push taxes off into the future, you may think to yourself, one of the things I can do is lobby to eliminate this tax in the meanwhile. And so, that's obviously a current feature both of the estate tax and of the realization rule. So what you can say about the billionaire income tax is directionally it's moving in the right direction. It's reducing the amount of political optionality, at least with respect to your public assets. But I agree it's not eliminating them. And
I like that idea of optionality. In fact, there's a paper, I mean, as you know, tax now or tax never. It's this idea, it's like if you can get your hands on it today, then it can't go away in the future. But if the system relies on something happening in the future, it's just tricky to...
The optionality reminds me a little bit of repatriation holidays. So these big companies were, when we had the worldwide tax system, they could defer their tax by not repatriating. So these companies would leave their earnings abroad, and then they would lobby for either a holiday or a change in the law. And they were successful. They actually got a tax holiday in 2004? And then they got the whole thing kind of repealed, basically, with TCJA in 2017.
Yeah. 100%.
Yeah, it's very interesting to think about, I do think what you're saying is interesting. What you're saying is this law would be a step in the right direction, but it maybe isn't perfect.
Yeah, and that's what the letter says too, right? We don't say this is a perfect statute. We say we think it's incrementally.
I think that is important for people, like me, who actually, like any new tax, you have a knee-jerk reaction just against it and try to find out the problems. If we would have sat,
I have the opposite reaction.
and I think it's healthy actually to have both kinds of people, because if you only had one, you had no taxes, and if you only had one, everything would be taxed, and somehow you meet in the middle. But I think it's important to remember, like every tax has a problem, right? Our current tax system, if we would have sat in 1915 and thought, should we have an income tax? We would have thought about the thousands of problems with an income tax, and never would have enacted it, and we never would have had the things that our income tax buys us. But I think a couple more questions about this new proposal. So you started out by saying the increases in the value of assets you hold. Now, despite the last couple decades experience, turns out assets don't always go up. So what happens if if prices go down?
Yeah, then you have a tax loss, and you can use it to the same extent that you could use capital losses currently. And so you might say, well, what happens during a recession when everyone's losing money? Doesn't a whole lot of money fly out the window? And I would say not really to any greater extent than it does today, right? There's already a huge incentive to harvest your losses when they happen. So the statute, marking to market doesn't probably accelerate losses. It only accelerates gains.
So to be clear, so when prices go down, it's not as if you would get an annual refund check. You'd have to have gains to offset.
That's how I read the bill.
And would you would a person's wealth be like? Would you track this on an asset by asset basis? So would it be sort of like the increase in my Tesla stock can be offset by the losses in my whatever other stock?
I do think that's how it works. Yes, and there's also there's a carryback in the bill. So if you don't have any capital losses. If you don't have any capital gains to offset with your mark-to-market losses this year, you can carry back to, I think it's 3 years.
So it's really very similar to capital gains taxes the way we have now, other than what you're doing is it's just on unrealized capital gains as opposed to only realized capital gains.
That's right. That's why it's worth emphasizing the income and billionaire income tax.
I was just about to ask,
really
why that income part?
Yeah, I mean, it's really just an extension of the current system. And also for kind of constitutional reasons, there are people who say, well, isn't a wealth tax unconstitutional? This may be something they kind of have vaguely heard about. And it's complicated. We do have a constitutional amendment that says Congress can impose an income tax. And so, from a legal perspective, one of the things the letter says is this is an income tax. It's just a way of figuring out when to measure your income.
And I like that. I mean, it's not just the letter says it. It's you put it in the name of the tax. It's like, this is an income tax. It's literally called the Billionaire Income Tax. Although, I mean, for certain, if this were passed, I mean, that like day one, you'd get constitutional challenges, and then who knows what would happen.
Okay, so this seems to be be controversial. So
every tax is, Scott.
Every
it's
tax
not like
is.
This is some special thing.
Yeah, I understand that, but so it's
right.
politically controversial. So when I walk out at lunch with my colleagues and we talk about taxing the billionaires, you would think, who cares? Like, none of us are billionaires. Like, this sounds like a great idea, right? But surprisingly, there are quite a few people who say, I dislike this because it reminds them of the individual AMT, which when it was first enacted was designed to tax, like, I don't know, 100 people or something like that. And by the time it was finally repealed in 2017, most of us sitting out there at lunch were paying the AMT. And I think they fear that this is a slippery slope, and soon we will all be paying taxes on our unrealized gains, not just the billionaires. Is there any way to protect against something like that?
I don't think so. I mean, like, it may be that it turns out that there are important features of the BIT that really only work if the number of people who you're administering it for is in the hundreds or thousands and not in the hundreds of thousands or millions. And so that's going to be an inherent limit on how widely you're going to expand the coverage.
So what are those limits? Like, why would it be harder to administer for more people?
I think that we already know it's pretty easy to administer a mark-to-market system for publicly traded assets once you have a reporting system, third-party reporting system, which we now do, where brokers have to report your basis. And so that part's easy. It's the other part of, the non-public assets and auditing them that I think becomes trickier when you have, a very large number of taxpayers.
Sorry, I might have completely missed this. So part of this would be brokerages doing third-party reporting on an annual basis on holdings and not just on realization like they do now under 1099B.
Right. I think that's probably, I don't see that reporting in the expanded reporting, in the bill, but
the brokerages know, so they could certainly be required to.
Right. And in the case of publicly traded stock, right, we're talking about people who probably own more than 5% of the company for the most part. So that also is, in the stock owner registry, you can see who owns the stock.
So if I ever become a billionaire, which I will not given my chosen profession, but suppose I did, with my amazing investments in quantum computing companies and other things that I do. If I ever become a billionaire, let's just suppose I'm happy to pay this tax. Like, it'd be cool. I'm so rich I get to pay the billionaire's income tax. It's like a status symbol. I'm going to think of it like that.
Right.
What I'm concerned about is, I want to be able to walk out at lunch today and say to my colleagues, you got nothing to fear. Don't be a hater. This is all good. It's going to help our society. We're going to tax these billionaires who aren't paying any tax. That should bother all of us. Nothing to fear. It's all good. Can I do that? Can I say that with confidence at lunch today?
Well, like I said, my knee-jerk reaction is this is the right rule. And it's not obvious why, if you have the right rule, you limit it to a small group of people unless there are administrative obstacles.
I see.
Now, it may be that taste of the American public for this rule on a mass basis will be limited, and we won't apply the rule. But I just think your economy grows so much faster because the realization rule does all these, bad things to an economy. It encourages people to hold their assets even when they're underperforming, instead of selling them to switch into a better investment. Right? I think the economic growth, by getting the right rule, is kind of worth
that lock-in effect you just
bit
suggested has very little to do with the law as currently proposed, right? This is like 60 or 70 or 80 people total. They're not not realizing just because they're not realizing because they own the company and they want to maintain control of the company and they don't want to pay these massive amounts of taxes. It's not they need to like re-diversify. It's not like Elon's, I only have Tesla. I need to sell and buy some Ford or something.
Actually, I mean, if you read the ProPublica series, there's a long laundry list of tax-motivated things that Elon Musk is doing, including business related to how he structures his businesses in order to claim things, to be able to treat some of his business costs as non-passive. Even though it's implausible that he's actually spending 500 hours a year on
everything,
17 different businesses, right? So I do think there's a lot of tax-motivated behavior by this population. I agree with you. If you're talking about 400 people, you're not going to have huge economic growth when you get their incentives right. The question was Scott's question, right? If this is a rule for, if not the masses, then let's say people who have $10 million in income or something, then I think you see real economic growth as a result.
So, I mean, do you think it is more administrative or more political that we start out with such a small number of people being subject to this?
Yeah, I think it's both. I'm a big believer in policy experiments, yay federalism. And so, it makes sense to me to try it in a limited population and see how it goes.
So here, I want to just get your opinion on an alternative, which would be something like this. Eliminate step up in basis. So whoever inherits whatever asset it is that's appreciated just inherits the same basis that the original owner had. And some might say, well, then that person can hold it forever, and then that person can hold it forever. And that does happen, and we just saw yesterday in the ProPublica thing that there are some of these dynasties who the grandchildren and great-grandchildren are still benefiting from the wealth. But my guess is it'd be very fascinating to see how much of that wealth had been turned at some point in a way that would have caused a realization of gains without a stepped-up basis. Is there any merit to just saying we eliminate step-up in basis?
Yes. And, I think that doesn't go as far in the right direction as the Billionaire Income Tax does, but I do think directionally, again, that's the right way to go. It doesn't make sense to say that if I work and sweat and earn $10 million, I should pay income tax on it, but if I, am born at third base and someone hands me $10 million, I shouldn't pay income tax on it. So I do think that should be taxed both from its perspective of tax design and just kind of like ethically. On the other hand, as a tax lawyer, I can tell you like trusts would be the classic way to avoid that problem. You just have a perpetual trust. You put the money in the perpetual trust and the trust never dies. I think that's what perpetual means, actually. And so that would be
throw that thing over in North Dakota and we're good to go. Is it North Dakota?
Most states now you're allowed to have a non-charitable trust that lasts forever. That didn't used to be the case 50 years ago. There basically were 0 states where that was true.
Very interesting. A topic for another day.
So one maybe last question. I don't know where we're at time-wise. Scott is the timekeeper.
Well, we're almost out. So Jeff gets his last question.
Yeah. So with the wealth tax, and when we were talking about the wealth tax, this is several months ago that there's been a lot of discussion about it. I mean, one of the common replies was like a lot of countries in Europe tried this and it failed for a variety of reasons. Has anybody tried something like a billionaire income tax? And what was the experience? Or would we be like the first, the trendsetter?
Well, you guys know that we already have mark-to-market taxation for, a lot of taxpayers in the United States, dealers in certain securities. We mark-to-market certain financial products already. We have mark-to-market for certain forms of foreign investment and so on and so forth. So it's not like this is an untried concept. In a sense, you could think of your standard depreciation schedule as using some mark-to-market concepts.
How many billions of dollars do we currently raise in all these mark-to-market?
That I don't know.
It's
off the
not
top of
very
my head.
much.
It's not a lot for the most part. I agree with you. This would be a bigger scale change than those have been. And so I think that you're right to say that marking to market all publicly traded assets and having a large class of assets that are not marked to market is not an experiment that we have done at a large scale before. Other countries around the world that have repealed their wealth taxes, in Europe, mostly that's been because of how easy it was to evade the wealth tax. So, if you read reports, it was so easy to set up a trust in Switzerland and put all of your wealth there, that over time those taxes raised so little money that they became very easy to repeal. So we think the experience would be very different with the billionaire income tax. But I agree with you. It would be new.
Yeah. So again, different because we would set it up differently initially, or different because we don't think politicians would create rules over time that would weaken the tax base that we initially set?
I think it would be harder to hollow out the tax to the point where there was no point in continuing it anymore.
Yeah, very, very interesting. Well, Brian, as we just mentioned, we're quickly running out of time. Thank you so much for joining us. Truly, I've learned a lot about what this might be and what it might entail, and the merits that it may have. And I look forward to lunch today because we're going to have a fascinating conversation trying to decide whether or not we should start writing letters to our favorite politicians in favor or against, as you guys have also done. So thank you so much for joining us. We'll see you next time. Goodbye.
Goodbye.
You don't have to say it creepy like that, Jeff.